The US dollar has been making waves since September 2024, partly fueled by Donald Trump's election as the 47th US president, with his second tenure that commenced on January 20th, 2025. South Africa, like many other countries, has already felt the wave of Trump's absolutely radical executive orders. He has cut aid to South Africa and will be seeking further sanctions against South Africa for enacting the Land Expropriation Bill. With the dollar's expected strength and Donald Trump's unpredictable policies, inflation and interest rates are expected to play a pivotal role in shaping global markets this year. In 2025, we expect the US dollar to flex its muscles, which will bring heightened volatility to currency markets. Hello everyone, and welcome back to FinEd, your favorite financial education channel. Before we begin, don't forget to hit that subscribe button and turn on your notification bell so you don't miss any of our new videos when they drop. Now, let's break down what the dollar's movements could mean for global equities and how you can adjust your portfolio to weather any potential storms. The USD index, or DXY, which measures the dollar against major currencies like the euro, yen, and pound, has risen to 107 from 100 in just a few months. For context, it peaked at 160 in the 1980s and bottomed at 72 in 2008. So, what happens if the dollar keeps climbing or if it reverses course? To prepare, investors should ask themselves the following two questions. 1. Will the dollar continue to strengthen or weaken? Number 2, how do currency movements affect US and international companies? Unlike stocks or bonds, currencies are driven by supply and demand rather than intrinsic value. Here are the key factors influencing currency prices. Countries that import more than they export often see downward pressure on their currencies. Investors buying assets in a country increase demand for its currency. Let's look at an example. If foreign investors purchase South African government bonds or equities listed on the Johannesburg Stock Exchange JSE, they need to buy South African rand to complete the transaction. This increases demand for the rand and can strengthen its value. When South Africa was added to global bond indices like the JP Morgan Emerging Markets Bond Index, it attracted billions of dollars in foreign inflows, temporarily boosting the rand. Higher interest rates often attract foreign investors, strengthening a currency. When the South African Reserve Bank SARB increases rates to combat inflation, it leads to foreign investors pouring capital into South African bonds, supporting the rand despite global economic uncertainties. The South African Reserve Bank often maintains higher interest rates compared to other developed economies. This attracts foreign investors looking for higher yields, strengthening the rand. Strong economies often have stronger currencies due to higher investment flows. A growing South African economy with increased exports of commodities like gold, platinum, and coal attracts investment, which can strengthen the rand. During the commodities boom of the early 2000s, South Africa experienced robust economic growth, which bolstered the rand as global demand for resources surged. Political or economic instability can weaken a currency. Political instability or corruption scandals in South Africa, such as the concerns during the Zuma administration, can weaken the rand due to reduced investor confidence. In 2021, when riots broke out after the imprisonment of former President Jacob Zuma, the rand depreciated significantly as markets priced in increased risk. Central banks can influence currency strength by adjusting interest rates or directly intervening in currency markets. The South African Reserve Bank has historically been proactive in using interest rates to stabilize the rand. In times of extreme currency depreciation, they might also sell foreign reserves to support the rand directly. In 2001, the rand hit record lows against the US dollar. The South African Reserve Bank intervened with a combination of rate hikes and open market operations to restore confidence in the currency. Several factors should continue to support the USD in 2025. Trump's policies are seen as pro-growth and inflationary, likely keeping US rates high. Deregulation could attract foreign investments into the US. The dollar often strengthens during global crises as it's considered a safe haven currency. Though less likely, a few scenarios could cause the dollar to fall. Economic slowdown could lead to rate cuts. Faster growth in Europe or emerging markets could shift investment away from the US. Any challenge to the Federal Reserve's independence could erode confidence in the US dollar. A stronger US dollar has mixed effects on global equities. Exporters to the US benefit as their goods become cheaper for Americans. Countries like Mexico, Canada, and India may gain from a strong dollar, particularly if they avoid tariffs. US companies with significant overseas revenue, for example, your Apple and your Microsoft, may see reduced earnings when converting foreign revenue into dollars. Meanwhile, industries focused on the US market, such as real estate or regional banks, tend to be more insulated from currency fluctuations. Whether the dollar rises or falls, it's wise to diversify your portfolio. For US dollar strength, focus on companies that export to the US or operate in industries resilient to tariffs, such as pharmaceuticals and defense. For US dollar weakness, consider growth-focused emerging market stocks, which could benefit from lower US rates and a weaker dollar. A stronger dollar might dominate the short term, but every surge creates opportunities for reversal. Keep a list of shares you'd like to own if the dollar weakens and maintain a balanced portfolio that can thrive in either scenario. Remember, it's not about predicting the future. It's about being ready for it. If you enjoyed this video, please don't forget to like, share, and subscribe to FinEd, your favorite financial education channel. Thank you so much for watching, and we'll see you in the next one.